Ladies and gentlemen, thank you very much for attending today's webinar and for showing interest in emerging markets in our strategy. Today, I would like to talk about the Mobius Investment Trust. We've been now around for 6 years. We launched in September 2018, a truly challenging period over the last couple of years to navigate in emerging markets. Nonetheless, we remain very optimistic about the opportunity set we're seeing in emerging markets as a whole. And we also see increasing validity of our model towards navigating into very innovative, well-run, founders-led business models across the emerging market spectrum, where we see a great degree of innovation, a great degree of competitiveness evolving. And all of this, of course, in a period where the global investment environment and economic environment in emerging markets continues to be quite negatively impacted by the US, by China, by geopolitics, by the war in the Ukraine, and many other factors like high interest rates in Brazil. Nonetheless, many of these companies continue to do really well. So let me take you through our presentation today. As I mentioned, our firm has now been around since 2018. We developed a very strong team that is laser focused on the opportunity set between 500 million and 3 billion market cap. So we focus on the mid cap segment. We've outperformed as we intended to do since inception. Over the 6 years, we outperformed the peer group and the benchmark. We had very volatile performance periods intermittently, like in 2019 and in the first quarter of 2025 and other periods, but continued to be absolutely convinced that over the long term, a concentrated approach with a high active share, which is significantly different to the benchmark, can deliver robust long-term outperformance. As you can see on this slide, since inception, MMIT delivered 43% versus the midcap index of 27% and the MSCI index of 24%. So very significant outperformance here. In terms of talking about volatility and sort of the challenges in the markets, you can see that it's really been a roller coaster. And the volatility index here measured by the VIX index indicates that volatility and the more recent past, we're always hoping for some improvements here, but as you can see here, the volatility actually is again escalating quite significantly on the back of Trump, on the back of geopolitical uncertainty. But it is, and we talk about this in a little bit, a very opportune time for emerging market private sector enterprises to benefit in this phase. The strategy itself offers a unique high quality portfolio with 25 to 30 high conviction holdings. It is clear that the quality is defined on the basis of the type of company we are finding. We are asking questions around competitiveness. We are asking questions about the people behind the businesses. We are looking at the facts rather than anecdotes. So we are analyzing in detail the financial performance. We also look at the sector in great depth. And we also, in every instance, are trying to understand how macro economic factors come into play and what sort of macro risks we are buying into. Clearly, we have a long-term investment horizon and turnover should, under normal circumstances, be quite low. But of course, in light of the very uncertain period that we continuously face, it also means that sometimes you do need to react, and we've done this in different periods. An MCP stock thus is a high quality name operating in an industry that is dominated by high growth, by expanding profit pools. We avoid regulation, we avoid state-owned enterprises, and we prefer companies which are sort of on the opposite side of the sort of more commoditized spectrum. I talked about modes. and ultimately companies which have strong governance and a very positive and strong corporate culture. Now, this is really probably the most important slide here we like to talk about today. And let me just spend a few minutes on this. This shows the top holdings. And let me just take you through some of those names. Clear is here that we focus on this mid-cap spectrum. What is also evident is that earnings growth expectations for the year 2026 is very decent. So we are seeing that these companies are moving into a high growth phase. What is also evident is that these companies have a robust balance sheet supporting their business. So looking at Classes as the number one example here, this is a typical Korean business which is focusing on exports. They're very strong in medical device exports. They have conquered markets around the entire planet. They are very strong in Latin America. They're very strong in Europe. They're very strong in Asia. They have not left out any market. They have so far left out the only market in the developed space where they haven't been focusing on over the last decade was the US because of regulatory issues, but also because of cost issues. Recently, they now started to obtain licenses also in the US. But this is a very impressive business founded by a family that has been in the driver's seat for many years. More recently, Bain Capital took control. They diversified their product offering. They have been very competitive in the sense that they also have a large portion of their revenue that they generate in the recurring nature. So they're selling devices that are being installed, and a very large part of the revenues are then products that are needed to support the devices throughout the lifetime of these devices. So a large portion of this are orders on the back of these replacement parts. So it's a strong compounder. Recently, there have been some rumors about the business being taken over by another corporate in Korea. But it's to us, it embodies and sort of exemplifies exactly the type of company we're trying to invest in emerging markets. Second one is Elite Material, equally attractive. This is a Taiwanese business, a global leader in copper-clad laminate, an essential material used in high-performance computing, but throughout the entire semiconductor industrial opportunity. They are an essential supplier to NVIDIA. They kept moving up in R&D, so they invested a lot in making sure they have the most competitive material available, and they are also increasing their volume, their client base out of Taiwan. Recent results are very promising, and especially with the new generation of chips coming out in the second half of this year, we're seeing again an increase in average selling price and significant orders coming through over the next year and a half. Another quite different example, and now turning to India, which has been certainly a hotspot for us. The core holdings have been Persistent Systems, but also APL Apollo, which have been tremendous investments for us, helping the performance over the last years. KPIT Technologies is a new addition to the portfolio. This is a global leader in software-defined vehicle technology. So they're developing software, middleware, but also various software applications for the automotive space. They've been growing very rapidly over the last years. They're very competitive, and we think that they will be at the forefront of businesses winning further market share as the automotive space is moving towards a higher software content. So quite interesting business here, also run by entrepreneurs and global in nature. They're very strong in Asia, they're strong in Europe, and they're strong in the Americas. Last example that I'd like to talk about here, which is a software business in Brazil, number 4 in the portfolio. Again, this business is the number 1 developer of software, enterprise software in Brazil. The Brazilian market is currently on a very solid path to recovery. after a difficult period with elevated interest rates, again, run by phenomenal people. They are diversified across all different industries in Brazil, and the software integration and demand for software, corporate software in Brazil is growing very rapidly. And the recent result again point towards a strong momentum here in the business. So these are some of the top holdings. As you can see, most of them, actually none of them are known by the wider market. You wouldn't find them in typical EM portfolios, and that's why you can see here 98% active share continues to be quite high. Car trade, a couple of examples I'm going to talk about here, which are new additions to the portfolio. This is a business which is still relatively small, 900 million market cap. It's run by a well-known family in India who moved into this online trading platform a number of years ago. They were founded in 2009. They're by now a multi-channel digital marketplace. They're catering actually to both new cars and the used car segment. They're very strong in this. They work closely with OEMs, so they're also directly working with OEMs to place their cars on the platform. And they control different brands. So they are very strong in two-wheelers, what they say, motorcycles. They are very strong in four-wheelers. But they also, in a very interesting deal, acquired a very large and successful classified business, OLX, in India. They're number one across the sort of auto portals, used classifieds, different categories. And they're still very small. So the car penetration in India is still one of the lowest among emerging markets and one of the fastest growing, as you can see here, compared to the UK, pretty extreme. And with a population of 1.4 billion, improving infrastructure, we're seeing this is a multi-year opportunity, growth opportunity. The trend and average ratio of pre-owned to new car sales in India also shows very strong trends. And the company has actually preserved a very high degree of financial discipline. They have, even in weaker periods, preserved the financial performance. They are profitable. They have a strong balance sheet. They have a strong backer by the founder family, which is highly sort of motivated to make this a success. And it's also sort of a family which has a long track record in the automotive space in India. So this is a new addition which we are quite excited about, and we look forward to enjoying this over the coming years. Elite Material, I touched on this briefly. Copper-clad laminates. They're an essential material used in printed circuit boards. They have a very strong market share, 28% globally, and they're specializing especially in these high-end copper-clad laminates for fast-growing industries like AI servers, high-performance smartphones, switches, etc. So that's very exciting, and we see that the space continues to sort of develop into even more sophisticated materials as the industry is moving more towards higher compute. The portfolio characteristics have been sort of preserved since we started the strategy. Companies have low debt, they have high return on equity, they're growing very rapidly, they have a strong profit margin and a very high return on invested capital. So that has been a common factor among portfolio companies. Now, talking about the performance, and I think I would like to make a very sort of important comment, which relates to our long-term performance, but also which alludes to the challenging first quarter of this year. Obviously, the only way to generate long-term performance, outperformance, is to stick to our goal of navigating to companies in the emerging market universe which are not yet discovered by the wider market, which are not in the index, And that often means, like you've seen here in 2019, but also in 2002, that there are periods where performance is challenged. And these are often, in relative terms, these are often periods where the broader market is repricing sectors and segments which have been totally neglected. So often these are short-term recoveries in sectors which we are not very interested in. So for example, overall the financial sector, traditional banks, or pure commodity businesses, or conglomerate state-owned enterprises. There are periods where they perform quite well in relative terms. But we continue to be convinced that over the long term, only businesses which can really evolve and which can really grow very significantly in size are the ones which will generate that long-term performance. And this year is a good example. We've been challenged. Last year we generated very decent outperformance. The year before we generated very decent outperformance. This year, companies in the finance sector, banks, traditional banks, but also commodities and China perform better than the rest of the world, partially driven by deep sea. So especially China tech did well. But those were companies which we, even if they trade at interesting multiples, wouldn't necessarily invest in because of various reasons. So in relative terms, we had a challenging quarter. Actually, as we speak, the momentum is coming back. The market is again bouncing back in our favor. So there is again this rebalancing and the focus more on fundamentals. So performance is coming back, and we continue. We have no intention to change in any way our focus or our strategy, and we believe that not just this year, but also the coming years, we will continue to be able to generate that outsized investment return. The country and sector allocation, as you can see here, has changed a little bit. India is now 23%. We utilized the recent weakness to build up bigger weights here and also build new positions, followed by Taiwan, which we lightened up a little bit on. We took profits in some companies, followed by South Korea, Brazil, Turkey, South Africa, and very little in China. We are looking at China. There are some interesting businesses in China with decent governance, but it's very thinly spread. So overall, we continue to be quite skeptical about the opportunity here. In terms of sector allocation, again, quite different: software, hardware, consumer discretionary, healthcare, semiconductors versus industrials and financials. And especially the financials this year, as banks sort of did relatively well compared to the rest of the opportunity set. This has caused some relative underperformance year to date. We've been very, very busy with trips in Taiwan and China, across Southeast Asia. We spent time in Vietnam. We're spending quite a bit of time in India. Actually, we're heading out to India again in a few weeks. So the on-the-ground work continues to be essential for us to build a pipeline of ideas and to be close to companies and manage the portfolio with knowledge and know-how and expertise that we gain from our on-the-ground visits. So good example is our intense meetings we had this year in Taiwan. Obviously, the learning has been tremendous. The network we utilized has helped us to gain a great insight. It's very difficult to put this into a brief presentation here, because we spent intense periods with these companies and learned a lot. It helped us to build conviction and sharpen our know-how about businesses, and allowed us to also learn about some new ideas in Taiwan. The Silicon Shield clearly is something which we think is very much in place, although the US is trying to move into production capabilities here. But this is this is something which can only happen over decades, and it's not going to be easy for anyone else to get even close to what Taiwan has achieved over the last 30 years. So we believe the dependency on leading edge chip production in Taiwan is not going to change anytime soon. And therefore, this competitive edge of TSMC and the whole ecosystem, we should expect this to remain in place for quite some time. Now, coming to the outlook, tariffs is obviously a key point, and this brings me towards sort of the last bit of my presentation today. There are clearly winners and losers, and what we do know is that we know very little in terms of how this will ultimately play out. Next big discussion appears to be China. I think that Trump will most likely continue to play hardball with China versus many other countries. It's clear that he's going to utilize this as he sees fit to play his agenda. Nonetheless, we see that there are countries like Korea, Taiwan, Malaysia, Thailand, which are less hurt, India clearly, which are much easier or in a much better position to deal with this. Turkey with 0 tariffs, South Africa 0 tariffs, Brazil as well, than others like China. So there's going to be uncertainty around this, and we just have to consider, or we have to assume, that it will remain unstable. There are different tariff scenarios which we can sort of model into our expectations. None of them is sort of guaranteed, so we always take a more conservative approach. Overall, the portfolio sees at this point a minimal vulnerability, as we are more into service businesses and more into sectors which have less exposure or are less vulnerable to these tariffs. Probably the scenario 2 with 10% so flat tariffs and certain trade deals is quite likely. That has a moderate impact on the world economy and on emerging markets specifically. But it's too early to tell, and every day brings new factors. The most important thing for us is to understand how companies, sort of what the breaking points are and how vulnerable companies are under the worst scenario. And here we've clearly navigated away from the beginning from those companies. If you look at the primary targets, it's quite clear that China is the #1 target. You can see how things are changing rapidly here with Vietnam tariffs on the 2nd of April, 56%, US tariffs level on the 6th of May, 10%. So a dramatic improvement. Thailand improvement a lot. Taiwan also improved a lot, but I wouldn't take anything for granted. It depends on factors that are very difficult to assess. I think what I would like to certainly talk about is that we are, and our holdings show minimal direct exposure to the US. So the average US revenue exposure is 18%. Also, the type of businesses, as I mentioned earlier, are those which are much less impacted by direct tariffs. Everybody is going to be somehow impacted, but of course, some businesses much more than others. And as a whole, we've been dealing with this intensely with our portfolio companies. We're seeing that they're quite immune and quite well prepared to deal with this. Also, remember that the rising intra-Asian trade reduces emerging market corporate dependency on US as a whole. And that's been a trend we've been observing over the last couple of years as the intra-trade between those countries is becoming significant and has taken over the dependency on trade just with China or Europe. Currencies continue to be attractively valued. We are seeing some recovery here. Taiwan recovered strongly. Brazil recovered strongly in January, but still overall, the currencies compared to their historical valuations are very attractive. The US dollar weakness is good for emerging markets as a whole. It makes them more competitive. Typically a weak US dollar means that emerging markets tend to outperform. The Chinese structural problems continue to be there, and they cannot be sort of fixed overnight, although the Chinese government is doing a lot to address them. and we are certainly staying close to that situation. But it doesn't mean that we will immediately see this rapid improvement here in sentiment in China, since the structural problems, debt, the real estate space, household debt, but also unemployment continue to show quite negative numbers. Whereas India looks far better. I'm not going to touch on every point here, but every single point, however you compare India with China, the trend for India is a lot more conducive, from infrastructure spending to domestic consumer demand, the state of the banks. So many investments which are now moving into foreign direct investments into India, that's helping really to drive growth in this country. So overall, that's the last slide I'm going to share with you today. We continue to be optimistic. One needs to be careful in the end, that's clear, but we continue to see earnings growth is coming through. Economic fundamentals are pretty intact and improving. Demographics are supportive. Monetary policy advantages are also coming through. And that's probably, those are the most important ones: innovation and valuation. Innovation is impressing us all the time in emerging markets, and we're seeing that some of the most exciting trends globally are increasingly sort of dominated by emerging market corporates, and they're playing an increasing role in this move towards innovation. And overall, emerging markets are certainly attractively valued compared to many other markets. So that's the end of my prepared presentation today. Thank you for your attention, and I look forward to catching up with you individually. Bye-bye.